This is C&N Vantage Point. I'm Craig Morgenstern, Senior Investment Officer with C&N Wealth Management, and today's podcast will provide a market review for the month of November 2023 and our current outlook. The holiday season kicked off this month with a strong and rapid rally across global financial markets, driven by moderating inflation rates, dovish Fed comments, and retreating bond yields. The S&P 500 index rose 9.1% for the month, swiftly emerging from near-term correction territory after just 16 trading days. The risk-on sentiment extended to small-cap and foreign equities as well, with the Russell 2000, MSCI EAFE, and MSCI Emerging Markets indices returning 9%, 9.3%, and 8% respectively. The most recent Consumer Price Index report showed headline inflation increasing at a 3.2% year-over-year rate, the lowest reading since March 2021. Core inflation increased at a 4% year-over-year rate, the lowest reading since September 2021. These figures provide the Fed much-needed breathing room to consider pausing rate hikes. Current Fed funds futures imply there will be no rate hike at the Fed's December meeting, and recent commentary from several Fed governors are consistent with a continued Fed pause. In fixed income, the 10-year U.S. Treasury yield sharply declined from 4.9% to 4.4% in November. Falling bond yields have pushed up bond prices. The Bloomberg U.S. Aggregate Bond Index returned 4.5% for the month, posting its best monthly return since May 1985, turning the index positive for the year. A notable exception to November's rally were oil and the U.S. dollar. WTI crude oil declined 6.3% during the month. The U.S. dollar declined 3% after hitting its intra-year high last month, driven by a growing consensus that Fed rate hikes have concluded. November serves as a reminder that strong market returns can occur in short periods of time and often follow periods of market volatility, such as those experienced in September and October. Of particular note is the sharp rally in a handful of stocks dubbed the Magnificent Seven: Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla, which have contributed 70% of the overall S&P 500 index return this year. This group now comprises 29% of the S&P 500 index market cap, and this level of exceptional index concentration sits at an all-time high. As prudent stewards of capital and proponents of well-diversified portfolios, these facts give us pause as we assess opportunities for risk-adjusted expected returns across the portfolio. Moderating inflation rates are encouraging, but still remain firmly above the Fed's stated 2% target. We expect the Fed will maintain the current Fed funds rate level, which is the 5.5% upper bound, for the foreseeable future. We do not see a recession on the horizon, but U.S. GDP growth in the fourth quarter will likely moderate. The Atlanta Fed GDP Now tracker is currently estimating 1.8% GDP growth in the fourth quarter. Elevated valuations, continued restrictive monetary policy, and lower GDP help to justify our continued defensive portfolio positioning. We'd like to remind our listeners that market conditions can change quickly. As circumstances and facts change, C&N's market views and portfolio positioning may change accordingly. If you would like more information about our current positioning and market thoughts, please contact any of our wealth management advisors. And if you like this podcast, we'd be grateful if you would share it with your friends. On behalf of the entire C&N Wealth Management team, thank you for listening.
Please note, views are subject to change based on market conditions and other factors. These views should not be construed as recommendation for any specific security or sector. Client portfolios may or may not be at the positionings discussed due to, but not limited to, distributions, tax management limitations, systematic purchases, etc. Some products are not FDIC insured or guaranteed, not a deposit or other obligation of the bank, not guaranteed by the bank, and are subject to investment risk, including the possible loss of principal amount invested, and are not insured by any other federal government agency.